Hello, everybody, and welcome. This is Intermediate Accounting 17th edition. Your video. This is Kiso, Weingart, and Warfield. This is problem 16.8. Textbook authors are Don Kiso, Jerry Weingart, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, so we're right now over here at problem 16.8. So the first thing we're being asked for to do is to compute basic earnings per share. And just as a reminder, our basic earnings per share is going to be our net income minus our preferred dividends divided by our weighted average shares outstanding. Okay. So right over here. All right. Our net income is 1.2 million. Our preferred dividends are going to be, so we had 4 million of preferred stock. And this 4 million of preferred stock basically, how many shares is this? This is basically, it's 100 shares or $100 par value. So this basically means over here that I had approximately 40,000 basically preferred shares issued. And let's just make this bigger all the way through. There we go. Okay. All right, so right over here. So this is how many total preferred shares we have. If I take my total preferred shares, of 40,000, the amount of the preferred dividend is at 6%. And I'm missing one thing over here. So this is basically, so it's 40,000. Par value is 100. And so over here, the value of my preferred shares is 4 million. My preferred dividend. And I'm kind of just going through, and why did I just not just take 6%, but you'll understand why I just did this momentarily. So we've got over here my, basically my interest, my preferred dividend is at 6%. So the amount of my preferred dividend is going to be 240,000. So this is going to be 1.2 million minus 240,000, or from right down here. And I'm going to divide this by my common shares outstanding. So for my common shares outstanding, again, if you see a $10 par value common stock, you know how I feel about that. And I do not like it one bit, but they told me they'd change it for the 19th edition. So hopefully it's coming soon. So my common stock, $10 par value, I've got 6 million. I have to divide this number here by 10. And so when I go over here, the actual amount of shares outstanding I'm going to have a total of 600,000 shares of common stock outstanding. Okay, so again, this problem gets a little bit cute. Well, I shouldn't call it cute. Can accounting really be cute? But what they're trying to go through and do is to try to like say, oh, they're not telling us the number of shares. Of course, you would know the number of shares, but we're just backing into that number. So this is my total common shares outstanding. Now, really quickly over here is that when we're looking at this, there's no treasury stock. There are options. I'm going to go through that momentarily, but for when we're doing basic earnings per share, over here, this is going to be 1.2 million minus my preferred dividends. And I'm going to divide this by my total basic shares. And I'm assuming that these were all done at the beginning of the year. There were no treasury shares, so we're good to go. Okay, so my numerator for my basic is going to be 1.2 million minus 240 divided by 960. And then over here, we're getting $1.60 per share. Okay, so my basic earnings per share is $1.60. And this number here is extremely important. So why is this number extremely important to us? It is because this is my basic EPS, because when we're going through and computing dilution, we never, if it goes above $1.60, what's going to happen to us is that the instrument is going to be anti-dilutive. So let's go through and figure this out. Okay, so for diluted earnings per share, right? So what we're going to do over here is let's start out over here with the most dilutive. What is going to be the most dilutive? Well, when I look over here at the stock options, right? So there was no changes in 2021 in the number of common shares, preferred or convertible bonds outstanding. There is no treasury stock. And why am I saying that they have common stock options? Why is this going to be the most dilutive? Because if you convert the debt, right, of this 6%, you're going to add back the interest expense. If you convert the bonds, you're going to be adding back that preferred dividend to the numerator. So if you're adding back on the top, that's going to be less dilutive than something like stock options where you're doing it at the bottom. So when it comes to stock options, I'm going to share with you something about how I like to do this over here. When we have stock options, the first question is, well, is it below market? And the answer is yes. If the average market price for common stock is $25 per share and the options are at 20 per share, these options are what we call in the money. Now, when we're going through and doing this, what we're going to figure out is, well, how many shares, if the options were exercised cashlessly, how many shares would actually be issued? And this is how we're going to figure this out. So over here, basically the current value of the stock options would be, or we'll just say, basically if the, let's just say if we had 75,000 shares, what would those total proceeds be? So let's just call this, I'll just call current value. Okay, so my shares over here are 75,000. My price per share for the current market per share is at 25. So this would be the value of if I had 75,000 shares at the current market price, this would basically be at 1,875,000. However, my strike price or my cost for these options is I'm going to have 75,000 shares, but my strike price is not at 20. I've got to pay for these things. So my price over here is going to be at 20 per share. Okay, so my cost of this is going to be 20 per share. So the cost of these shares to me would basically be 1.5 million. So if I were to buy the options and then sell them, what would really my profit be? And that's what we're kind of trying to figure out. So over here, the value of the options is 75,000 times 25 or 1,875,000. The cost of the options is 70,000 times 20 or 1.5 million. So the potential profit from the exercise of these options would be 375,000. Now, I'm not looking for that number though. What am I actually going through and looking for? Well, when I'm going through and doing fully diluted earnings per share, I'm starting over here with my net income minus my preferred dividends divided by 60,000 shares outstanding. Right, so this is a dollar amount. I need to figure out what this is in terms of shares, right? So in order to find out what this would be in terms of shares, the real question is, well, if this is my profit, so if my potential profit from the exercise of these options is 375,000, how many shares would this equal to? Well, my price per share is going to be, or what I could buy it out in the open market would be $25 per share. So the number of shares that I could purchase if I went through and cashed them in, this is going to be what I'm going to be putting in the denominator of my question, which is basically the exercise of the stock options. Okay, so what I want to do with you at this point is that, I'll make this a little bit smaller. What I want to do with you at this point, though, is to say, well, what does this look like right now? I got 1.2 million minus 240. And then I've got 60,000 plus 15,000. So over here, wow, why did that not look right? Hold on. 1.2 million. Just give me a second. Oh, I'm an idiot. This is actually not 60,000, it's 600,000. Oh, there we go. Okay. I can call myself an idiot. It's okay. I try to be a kind idiot, hopefully not the village idiot. Right over here. Okay, so basically over here, I've got $1.56 per share so far. Now, when I look at this, is the $1.56, is this below the $1.60? The answer is yes. So I'm going to start first with my most dilutive. Okay. Now, what is going to be my second most dilutive and my third most dilutive? Let's go through and figure those out. So let's take a look at what happens over here what happens if these 2 million of bonds are converted. So these I have over here, I have 2 million. So my bonds over here are at 2 million. My par value per bond is 1,000. So the total number of bonds that are going to be outstanding right over here is going to be roughly 2,000. So if I take this 2,000 right over here, and these are each convertible into 30 shares of common stock. So the total shares of common stock that would be issued would be 60,000 shares. Okay. But when I have a bond, though, what I have to also remember, if this bond converted, then what would I get? I would not have to go through and pay interest. So over here with this bond over here, I've got 2 million of bonds. These bonds are at 7%. So my total interest is going to be 2 million times 0.07 or 140,000. So potentially I could be saving 140,000 of interest, but This interest is pre-tax. So when you're looking at net income, this is net income after tax. So what I'm going to need to go through and do is I'm going to have to say, well, my tax rate is at 20%. I multiply this through 20. Basically, my income taxes are going to be 28,000. And so my total interest savings after tax is going to be 140,000 minus 28, or 112,000. Okay, that's a lot of fun. All right, now here's what was messing me up, is that when I come down over here and I take 112,000 divided by 60,000, this number is actually going to be $1.87. And when you look at this $1.87, you kind of going, dude, it's $1.87. Like right over here, this is $1.60. So I would assume that it would be anti-dilutive. But what we're going to do first is we're first going to do the same thing now for the preferred, and then I'll show you what we do next. Okay, so for the preferred stock, right over here, the preferred stock we said that how many shares of preferred stock we have. Well, Bennett, like you went through and did that work earlier, so great. We basically had 40,000 shares of preferred stock. 4 million divided by 100 par value means we have 40,000 shares. Okay, so when I look at this over here, the way it's going to be convertible, it's going to basically be every 3 shares of stock I'm going to have over here at 40,000. So I'm going to get 120,000. Now, when we go through and look at this, so if the preferred stock converts, I'm going to issue out 120,000 shares, right? So now, if the preferred stock converted, though, similar to this little equation over here, well, guess what? I don't have to pay preferred dividends. My preferred dividends are 240,000. And over here, if I'm issuing out 120,000 shares, what's going on here is that we have a problem because this is now going to be at $2. So because this is higher than the basic EPS per share, what we're going to go ahead and do is we'll go ahead and look at these numbers. So let's take a break. Let's take a step back for a second. First thing we went through and did was we computed basic earnings per share, net income minus preferred dividends, divided by the weighted average shares outstanding. Then we started with the most dilutive security, which is the issuance of stock options. These options are in the money because they're at $20 per share as opposed to the market price of 25. So if these were to be exercised cashlessly, another 15,000, I could basically, it's the value of these options are 15,000 shares. This is the most dilutive because when you go through and do this, there's nothing that's coming off of the numerator. Okay, so let's now go through and see what we're going to go through and do next. So this is definitely going to be included. So right over here, I've got 960 plus 615. Now, the next question is, what is the next most dilutive security? Well, the preferred dividends are, the preferred stock is at $2 per share. The option, basically the amount of shares that would be issued as a result of the convertible bonds, right? So this is my interest savings divided by the shares issued if converted. So what I'm going to do here, and even though this is a $1.87, you might say, Tchaikovsky, this is going to be dilutive. We need to go through and add this in here, right? So you get 112 and 60. And the reason why we're going to go through and add it back is we want to see if this amount here, if the diluted earnings per share is still at $1, as long as it's less than $1.60, we can keep it. So over here we have 1,072,000, and then we've got 675. Okay, so this is over here. Do some nice little coloring. This is starting to look like a weighted average perpetual inventory question. It's all related. So this is my convertible bonds. Okay, this is with the stock option and convertible bonds. Okay, so over here, when I take 1,072,000 divided by 675, drum roll, please. What am I going to get over here? Well, I'm going to get $1.59, which is, okay, so if you're taking my class, I'm never going to give you something like this. It's going to be really dilutive, and it's probably going to be messed up. But that's because I love my students so much, and I need to challenge you to make sure that you're the best accountants in the world. But this is just a messed up question, and I'm messed up, but I wouldn't do it like this. So this is at $1.59, and what the solution says you do is you keep it because overall it's still dilutive. Although I'm not sure if I necessarily agree with it, but in any event, we'll just go with it. So we'll say that the answer here is $1.59. Now, what if I took now this part over here, which has with the stock options and then with the convertible bonds. And now let's do the really fun part over here. So if I add in the preferred dividends, the preferred, we'll call it the preferred stock conversion. I'm going to add back 240,000 into the numerator because I'm no longer, needing those. I'm basically no longer paying the dividend, and then I'd be issuing 120,000 shares. So as a result over here for this particular one, okay. Now, when I divide this over here by this is literally going to give me $1.65. I'll make sure this is right. So this is going to be $1.65. Because the $1.65 is greater than the $1.60 up here, we do not include this. So this is no, do not include, because the preferred stock conversion is anti-dilutive, as the total EPS would increase above basic EPS. Okay. All right. So that is problem 16.8. And I think I actually, believe it or not, I actually did this question a while back, but I think it just continually messed me up because I didn't really like this $1.87. But frankly, this is and even in the solution, and I can just show this to you, this just doesn't really make a lot of sense, because even in their solution, what they're doing is they're comparing it to the $1.59, which you computed here. And that's not what it is. It's basically, if it's greater than basic earnings per share, then you stop. It's anti-dilutive because it's going to create a value that's greater than basic earnings per share. That's why you don't do it. So, but in any event, I want to thank all of you for that's. Oh, wow. I showed the Wiley solution. I'm not sure if I was supposed to do that, but it's kind of fun. I don't know who's going to be watching this video anyways. Maybe someone will get really mad at me. Who knows? It's fun though. In any event, I want to thank you for joining us here on our accounting journey. And hopefully by the 19th edition, they'll get rid of this junk called $10 per share par value, which will get you, well, you can't get disbarred as an accountant, but it should be kind of fun. You'll probably be committing some sort of accounting malpractice. But in any event, I want to thank you for joining me here today. I also want to thank Wiley, that even though I may not always agree with their solutions, it's still the best textbook out there for intermediate accounting, hands down. And in any event, I look forward to seeing all of you on the next video. Have a great night.